Markets have seen a sharp correction over the last 1 week, falling close to 10% from the peak. A lot of investors are getting nervous, worrying whether this could be an extended downtrend. For us, especially if you're a long-term investor, any correction is an opportunity to invest. And especially where India is positioned as of now, there are strong tailwinds to suggest that Indian economy is at the cusp of a multi-year upcycle. And you could have very strong GDP growth rates over the next 3-4 years. Data points suggest that real estate transactions are picking up. Mortgage rates are at 20-year low, which is again a very strong multiplier for the economy, because when you buy a house, you fill it up with furniture, consumer durables, you will buy possibly a car or a two-wheeler, which again creates a very strong multiplying effect on the economy. IT hiring is very, very strong. Again, these are very high-paying jobs, and there are research studies done to suggest that every one job created in IT creates 4 other jobs in the other parts of the economy. You are seeing some evidence of capex cycle picking up. You are seeing credit growth picking up, which was low for the last few years. So at least, and government expenditure remains very, very strong over the next few years. So our sense is, given the strong tailwinds and the fact that we have had almost 7 years of weak economic growth, there is hope that this could trigger a very strong uptrend in economic growth, and it could last for next 4-5 years. And earnings will follow strong GDP growth, and in a strong earnings environment, it is unlikely that the markets will see a significant correction. If interest rates globally were to move up, there is risk that flows to India might get impacted because cost of capital will move up. But again, that impacts the price of assets, not necessarily the value of assets. Value is linked to the company's revenues and profitability growth, and you might have some sell-off in the asset prices, but eventually it will follow earnings growth, and we expect that to bounce back once Indian companies start delivering strong earnings growth. So if you're a long-term investor, how should you position yourself? Again, if you're a thoughtful investor, first is not to get swayed by short-term market movements. If there has been a strong rally, you must expect some correction along the way. The thing to do is just to focus on your long-term asset allocation. If you're an investor with many years of investing left, your goals are far away, then Quantum Mutual Fund has a very simple template of 12, 20, and 80, a very simple template to follow for your long-term asset allocation. You should put away your 12 months of expenditure first as emergency corpus. Of the remaining, put about 20% in gold, and of the remaining balance, 80% should go into equities. Within that, you can put about 15% in Quantum Long-Term Equity Value Fund, about 15% in Quantum ESG Fund, and the remaining in Quantum Fund of Funds, which should gather the bulk of your investments, because it's a pool of 8-9 diversified equity mutual funds. So that itself should cover your entire investment basket. And just focus on your long-term asset allocation. Short-term variation should not move away your focus from long-term asset allocation plans. Quantum Mutual Fund on their website has created a wonderful dashboard. Once you log into your account, it will tell you what the suggested allocation is and compares your existing allocation against that suggested allocation. And you can rebalance your portfolio based on that long-term suggestion if you think that is best suited for you. So again, if you're a long-term investor, market corrections are par for the course. In every rally, there will be corrections. Long-term India's story remains bright. Stick to your asset allocation and continue to invest and build your long-term corpus.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.